Hello and welcome to our training on the Inflation Reduction Act, or IRA. I'm Jack Carney at Lauterbach Amen, and today we'll be walking through how schools and other government entities can access cash payments under this groundbreaking legislation. Whether you're considering clean energy projects or already exploring funding options, this session is designed to help you navigate the opportunities available through the IRA. So before we go into the details of the different types of tax credits available, just a little bit of background on the IRA itself. The Inflation Reduction Act was signed into law back in August of 2022. After months of negotiation and legislative movement, it was built on the Build Back Better framework. So this over 700-page law is the most significant investment in energy and climate in U.S. history. It allocates over $500 billion to these initiatives, and it was passed through a process called budget reconciliation, which allowed it to move forward with a simple Senate majority. And importantly, the tax credit provisions we'll be focusing on today were preserved even during debt ceiling talks. So it highlights how central they are to the law's purpose. Historically, tax credits have only benefited entities that actually owe federal taxes. So this leaves out schools, nonprofits, many public agencies. The Inflation Reduction Act changed that. Under Section 6417, eligible governmental and nonprofit entities can now receive direct cash payments for qualified clean energy and electric vehicle projects. This is called elective pay or direct pay, and it essentially unlocks tax credits for organizations that never had access to this before. So one key caveat though, these credits cannot be sold or transferred. You must directly apply to the IRS. Okay, so how does the timing of this all work? Direct pay is not upfront. Your school district or other government entity can only receive the funds after the clean energy project is fully financed, installed, and placed in service. That means that planning is crucial. After the project goes live, you'll complete an IRS pre-filing registration where you'll get a pre-filing registration number that will go on the tax return that's filed, the 990T. And then once the return is processed, you'll receive the cash payment. So it's a multi-step timeline, but it's well worth it. And normally we see clients receive the direct payments within 3 months of filing. Okay, so here's a very common source of confusion, and that is that the IRA only applies to taxable years beginning after December 31st, 2022. So that means if your fiscal year starts mid-2022, any projects placed in service before your 2023 tax year begins technically don't qualify. The IRS has made it clear, no exceptions. We will cover a fix for this in the next slide, especially for schools and entities without a regular federal tax filing requirement. So thankfully, there is a solution to that fiscal year limitation. So for example, let's say a school district places a clean energy project in service between January and June of 2023, but their fiscal year started in July of 2022. That project wouldn't qualify under the default rules. However, the IRS's final regulations now allow entities like schools, which don't normally file federal income tax returns, to adopt a calendar year basis solely for this purpose of claiming elective pay. This gives you great flexibility and ensures you're not penalized just because of your fiscal year calendar. So before we move on to the different types of credits, I just want to give another example of like a fiscal year issue. So a school with a July through June fiscal year installs solar panels on April 1st of 2023. Thanks to the updated IRS guidance, they can choose to file the Form 990T using a calendar year and still claim the elective pay. And this does not actually change the school's fiscal year, the way that it operates or gets audited. This is just in the eyes of the IRS. And so this flexibility is a huge game changer for schools still trying to take advantage of those clean energy credits. Okay, now let's talk about what types of credits schools and similar entities should really be paying attention to. And there are really three main ones. First, Section 45W for electric school buses and clean vehicles. Second, Section 30C for electric vehicle charging stations and alternative fuel equipment. And third, Section 48, the investment tax credit, which covers solar, battery storage, geothermal, and other clean energy property. And these credits are really powerful tools, and now they're accessible to schools through direct payment. Electric school buses are already gaining traction. As of late of 2024, over 60 school districts in Illinois alone have adopted electric buses. Not only are these vehicles better for the environment, but they also qualify for meaningful tax credits under the IRA. If your district is considering new transportation investments, electric school buses could bring both sustainability and federal dollars to your fleet. And of course, with electric vehicles comes the need for infrastructure. Charging stations like these, iCharge wall mounted units, are eligible under Section 30C. This applies to a variety of refueling technologies, not just for cars, but also school buses, vans, and even forklifts. If you're installing chargers at your facilities, you may qualify for up to $100,000 per item of equipment in tax credits if the project meets location and labor requirements. Historically, we've seen these are a bit less common for some of our school districts just because of the location that they're in, but that doesn't necessarily mean that yours is disqualified right away. Solar is one of the most common clean energy investments for schools. Projects like these, whether rooftop or large scale, are eligible under the investment tax credit. Systems that generate electricity, heat, water, or even storage energy may qualify. The bigger the system, the more you could potentially save. When investing in clean energy, entities can choose between the investment tax credit or the production tax credit. The ITC gives you an upfront percentage of the system's cost, while the PTC gives you payments over time based on how much energy your system produces. And so we see schools usually benefit much more from the ITC immediate return. So in 2025, Section 48 actually transitions to 48E. Instead of listing eligible technologies, credits will now be based on whether a facility's emissions are effectively zero. So this approach allows new technologies to qualify. So the cleaner the energy, the more support you'll get. So these credits will not last forever. The ITC phases out after national electricity emissions drop below 25% of 2022 levels or by 2032, whichever comes later. So now is a great time to start planning if you do want to still maximize these benefits. Not all projects are created equal. So the credit value depends on the size, location, labor standards, and the timing of the projects. And for smaller projects under 1 megawatt, fewer rules apply, which actually can make them easier to qualify for and more appealing for some schools. And many of our school districts that we've worked with actually fall under this 1 megawatt requirement. The good news is you don't need to compete or apply for a limited pool of funds for these credits. If your project qualifies, then the credit is yours. This is an entitlement, it's not a grant. The Inflation Reduction Act changed how the investment tax credit is calculated. So now these credits have a base rate, it's typically 6%. However, they may jump to 30% if you meet labor rules, or for smaller projects under 1 megawatt, you get the full 30% automatically. And then bonuses are also available for domestic content, energy communities, and low income areas. And one thing I'll note on this is virtually every county in the Chicagoland area falls under within an energy community. So that's an additional 10%. So we're looking at potentially 40% credit on the basis of the solar project. And there are really four main goals of the IRA. It's not just about clean energy, it is also about creating jobs, boosting U.S. manufacturing, revitalizing fossil fuel communities, and providing environmental justice. Each of these goals ties into bonus opportunities for your projects. And so for the next few slides, we're going to be discussing the four different bonus credits that may apply. So there's the prevailing wage and apprenticeship requirements, the domestic content bonus, the energy community bonus, and the low income community bonus credit program. Starting with the prevailing wage requirement. So for large projects, this means any project over 1 megawatt of output. The 5x multiplier applies only if you pay workers prevailing wages based on federal labor standards for construction and maintenance. So if you miss this, you're going to lose out on a big chunk of the credit. It's really the credit really only can become about 6%. Large projects also have to include apprentices. So a certain percentage of work hours, up to 15%, must be done by qualified apprentices. So if you don't meet this requirement, penalties will apply unless you made a good faith effort. And what counts as construction, alteration, or repair? The labor rules apply to any construction or modification work, even if it's done offsite or through contractors. Routine maintenance does not count, but almost everything else does. Our next bonus is the domestic content bonus. So if you use American-made steel and equipment for the solar panels, you can get an additional 10% bonus. And requirements phase in over time and ramp up to 55% by 2027. So for large projects, failing to meet these standards could also reduce your ability to claim direct pay. Our next bonus is energy communities. So if you build in a former coal or oil community or on a brownfield site, you might qualify for an additional 10% bonus. But again, the full bonus only applies if you meet the labor standards on projects over 1 megawatt. If your project is under 1 megawatt, then you are automatically at the 30% bonus and you'll get this 10% without having to meet the labor standards. And as I mentioned in the previous slide, nearly every single county in the Chicagoland area has met the energy community standards to get the additional 10% bonus. And our fourth bonus, the low income and tribal communities. Small solar and wind projects under 5 megawatts in low income or tribal areas can earn a 10 to 20% bonus credit. These require a special allocation from the Department of Treasury, so please apply early for these. So we've talked a lot about, the difference between a 1 megawatt project and one that's less than 1 megawatt project. But how big is a 1 megawatt project actually? To keep it simple, a 1 megawatt solar project usually needs around 3 to 5 acres of space. And the 1 megawatt threshold is very key for the credit rules. So know your system sizing going into it. That's huge. If your project is under 1 megawatt and meets certain IRS tests, like having shared financing or land, you may be considered a single project. And that determines whether you qualified for simplified credit rules or face more requirements. Each project's credit amount will depend on eligibility and stacking rules. So you need to do, careful calculations to get this right, especially when combining funding sources. But to just to give a very simple example, and one that we see quite common, the credit value. Let's say you have a project, a solar panel project, where the total electrical output is under 1 megawatt. So there's the 5x multiplier comes into place. So the credit is now 30%. We are in an energy community. So there's 10%. So we're looking at a 40% credit on the basis of the solar panel property. So grants do impact these credits. If your project gets a restricted grant, it could reduce the eligible tax credit. And so the credits cannot exceed the total project cost. So planning for the funding sources is very important to avoid losing value. And here we can see 3 different examples of how grants impact the credit in each situation. So we just covered the solar panel tax credit. Now let's move on to qualified clean vehicles under Section 45. So if you're thinking of buying electric school buses, Section 45 gives a credit of up to $40,000 per vehicle, depending on the weight. And the credit is capped, but available through direct pay. And the nice thing about this credit is that no labor or content rules apply. So this makes it one of the simpler credits to apply for. To qualify, the vehicle must be for use, not resale, have a battery of over 15 kilowatts, and be built by a certified manufacturer. So it's very important to include the vehicle identification number when filing, not only on the 990T, but also in the pre-registration filing requirements, because that VIN number is going to tell the tax preparer and the IRS the amount of the credit that that vehicle qualifies for. Moving on to alternative fuel charging under Section 30. So if you're installing chargers, Section 30 covers that, especially in low income or rural areas. You can earn up to $100,000 per charger if the labor rules are followed. There are no bonuses available for this credit. Still a very strong incentive. The one thing that I will mention is that the chargers must be in a low income community. As I mentioned in the previous slide, Section 45W does not allow bonuses. However, Section 30C does allow a 5x multiplier for labor compliance, but no other extra adders. So just watch out for potential reductions if your credit plus grants exceed costs. Before we move on to allocation of funds and looking at actually applying for these credits, I'd like to point out on this slide just how useful this is. There are links on this slide that will point you to if you are located in a low income community or if you are located in a energy community. These links will actually tell you through government websites if your location qualifies for those additional 10% bonuses. So if your entity is financing a mix of properties such as solar panels and electric vehicles, it would be a very good idea to use tax-exempt funds for vehicle and charger projects first because they are not penalized for it. And then save the taxable funds for solar and battery projects to avoid reductions in the credit value. So planning your financing is crucial to maximizing the returns available. So once your project is placed in service, your school district can finally apply for direct pay using the IRS portal here on this slide. And so you'll start by registering with the IRS using their online portal, ideally right after the project is placed in service. And you'll need to register at least 120 days before filing your full tax return to avoid delays. And here we have additional links on step-by-step guides on how to apply for the pre-registration numbers. And this is something that we have helped our clients with filing for as well. And so the whole point of applying for the pre-registration number with the IRS is because that pre-registration number is then going to go on the 990T tax filing that the accountant will do. And so within the 990T, there are actually sub forms that need to be filed depending on which credit that you have. So the form 3800 is the general business credit form where the total of the credit will be shown. If you have solar, then we'll have to also include a 3468. And different clean vehicles will also have a form 8936. So the rest of these forms, which is something that us or your accountant will be able to handle, is very much why we have those pre-registration numbers in the first place. So one of the most important pieces of actually getting the registration number in a timely fashion with the IRS is to provide just the most basic project details. So like the location, ownership, funding sources, construction timelines. Many times the IRS will follow up with questions or requesting more information. So we've seen the more information that we can provide them up front on the project, the better. I mean, this including titles, deeds, certificates of ownership, anything that we can provide to them and upload into the portal will increase the speed of turning around the registration number. There have been situations where there can be delays for months because the IRS needs more information. We upload it, they take another 2 months to look at it. And so the more that we can give them upfront, the quicker the whole thing will go. And a really easy way to give them all of this information is in one bulk upload Excel template. They actually provide a template that we can use to upload everything at once. And this is a really, really nice tool that they have given us to to upload and file and get the pre-registration number as quickly as possible. So the direct pay deadline is critically important. You must make your direct pay election by your tax return due date. And again, your tax return due date depends on your fiscal year or if you elected to use the calendar year. There are no late filings. So for most schools, that's going to be May 15th, following the December year fiscal year end. If your school district is a junior end, that is going to be due on November 15th. So very important that we are on time with this. And just to visualize what that looks like, so here's an example. Let's say your project is placed in service in June of 2024. You register by July and you file your tax return by November of 2024. And if it all goes smoothly, you'll receive your payment shortly after, usually within 3 months in the form of a check. So the timing and documentation are key to all of this. So that brings us to the end of today's session. Thank you so much for joining us, and we hope this helped clarify how the Inflation Reduction Act can benefit your school or district. If you have any questions at all, we are here to help.